The world is changing at an unprecedented pace. Investors are no longer solely focused on profits and financial returns. They are increasingly aware of the broader impact their investments have on the planet and society. This shift in mindset is driving the rise of ESG investing, which stands for environmental, social, and governance. ESG represents a fundamental change in how we think about finance and investment strategies. It encourages us to consider the long-term effects of our financial decisions. ESG investing is not just a passing trend, it is a powerful movement. It is a recognition that financial success and sustainability are deeply intertwined. By directing capital toward responsible companies, investors can help build a more just and sustainable future for all. This essay will delve into the core principles of ESG investing, examining its foundations and benefits. We will explore its growing significance and illustrate its real-world impact through various examples and case studies. ESG stands for environmental, social, and governance. These three pillars represent the key factors considered when evaluating a company's sustainability performance. The environmental pillar focuses on a company's environmental footprint. This includes factors like carbon emissions, resource consumption, and waste management. The social pillar examines how a company treats its employees, customers, and the communities in which it operates. Factors considered include labor standards, human rights, and product safety. The governance pillar assesses the quality of a company's leadership, executive pay, shareholder rights, and ethical business practices. ESG investing has witnessed a meteoric rise in recent years. Investors are increasingly recognizing that ESG factors can significantly impact a company's long-term profitability and sustainability. For example, a company with poor environmental practices might face regulatory fines or reputational damage. Similarly, a company with weak corporate governance might be more susceptible to scandals or mismanagement. As a result, investors are integrating ESG factors into their investment analysis. They are actively seeking out companies that prioritize sustainability and responsible business practices. Section 4: ESG in Action: Real-World Examples of Impactful Investments. The real-world impact of ESG investing can be seen in various sectors. For instance, investors are increasingly supporting renewable energy companies. They recognize the long-term growth potential of clean energy as the world transitions to a low-carbon economy. Investments in solar, wind, and other renewable energy sources are growing rapidly. Another example is the growing focus on sustainable agriculture. Investors are supporting companies that promote sustainable farming practices, reduce waste, and improve food security. This includes companies developing innovative agricultural technologies and promoting responsible land management practices. Section 5: The Twofold Advantage: Financial Returns and Ethical Impact. ESG investing is not just about doing good, it is also about doing well financially. It represents a holistic approach to investing that considers environmental, social, and governance factors. Studies have shown that companies with strong ESG performance often outperform their peers in the long run. This is because they are more resilient and forward-thinking. This is because they are better positioned to manage risks, adapt to changing market conditions, and capitalize on emerging opportunities. They are proactive rather than reactive. Moreover, ESG investing aligns with the values of a growing number of investors. These investors are increasingly aware of the impact their money can have. They want their investments to not only generate financial returns, but also contribute to a better world. This dual focus is becoming a significant trend. This ethical dimension is a key driver of the ESG movement. It reflects a shift towards more responsible and sustainable investing practices. Section 6: Embracing Transparency and Measuring Impact. Key considerations for ESG success. Transparency and impact measurement are crucial for the success of ESG investing. Investors need reliable data and metrics to assess the sustainability performance of companies. This requires companies to adopt standardized ESG reporting frameworks and disclose relevant information in a transparent and comparable manner. Furthermore, it is essential to develop robust methodologies to measure the real-world impact of ESG investments. This includes tracking progress on key sustainability indicators and assessing the social and environmental outcomes of investment decisions. Section 7. A future forged by responsible investment towards a sustainable and equitable world. In conclusion, ESG investing is more than just a trend, it is a transformation of finance, reshaping the way we think about our investments and their impact on the world. It reflects a growing understanding that our financial decisions have far-reaching consequences, influencing not just our portfolios but the very fabric of society and the environment. By embracing ESG principles, investors can direct capital toward companies committed to sustainability, social responsibility, and good governance, ensuring that their investments contribute positively to the world. This shift toward responsible investment is essential for building a more sustainable and equitable world where economic growth does not come at the expense of our planet or social well-being. As we navigate the challenges of the 21st century, ESG investing offers a path forward, guiding us toward a future where our financial goals align with our ethical values. It empowers us to create a future where financial success and sustainability go hand in hand, fostering a world where prosperity is shared and the environment is protected. Let's invest in a brighter tomorrow today by making choices that reflect our commitment to a sustainable and equitable world.